Well, welcome back to Finance Uncut. On today's episode, inflation up, gold up, and silver up. So what's interesting when I was looking at the gold market in particular, but silver's done really well as well. Gold had actually fallen $6 an ounce. But when the CPI numbers were coming out in the last 20 minutes of those numbers, we saw gold shoot up $21. So, yeah, it'd be very interesting to see the BOFA investor survey to really see if 2/3 of investors still believe that inflation is transitory. And you can see from the silver chart, you can see when the US CPI numbers came out that silver absolutely skyrocketed. Big jump up to over $25 an ounce. And yes, it's pulled back somewhat, but it seems to be holding that line above $24.60 an ounce. And it does seem to me that there has been a breakout from that low of $22 a couple of weeks ago, which is what I expected, and this I think is good signs. And so, as I'm sure you're all aware, CPI came in hot at 6.2%, way above the Fed's target rate, and it's actually the highest it's been for 31 years. And where's the Fed funds rate at the moment? Where were the Fed funds rate when we had CPI like this before? Obviously nowhere near where it is now, but 6.2%. But is that accurate? So I love this tweet from Charlie Bellello, just breaking down the CPI report, and you can see there the price increases from gasoline, used cars, meats, electricity, etc. But have a look down the bottom, shelter, 3.5%. We know that rents, and this isn't just a US issue, this is around the world, but rents are rising more than 3.5%. Housing is rising more than 3.5%. And yet, housing makes up such a large portion of the CPI number. So if it's 6.2%, I'd really like to see shadow stats. I wouldn't be surprised if shadow stats are somewhere around 14 or 15% by now. But what we'll do now is we'll cut to a clip with Professor Steve Hanke.
Professor Hanke, welcome back to the show.
Good to be with you, David.
As I've explained, you were right in calling for higher inflation. And not only were you right, you were very explicit in saying 6% is the magic number to watch for. In fact, you have said that it could potentially go up even higher than 6%. Well, here we are, 6.2%. And I know what you're going to say. You're going to say that inflation is everywhere a monetary phenomenon. You see, I've memorized some of your catchphrases already, but you're absolutely right, Professor. And I would like to start by talking about the M2 money supply. Doesn't seem to be stalling anytime soon in terms of its momentum. Does this mean that inflation could go up even higher?
Yes, it could go higher, and the main thing is persistence. This talk we have, it's all political nonsense, and all the analysts, the economists have it all wrong. They're talking about inflation being temporary, and it's a supply chain problem. This is just utter rubbish. The CPI and inflation are driven by the money supply growth. It's the money supply growth that makes inflation go up or go down. And we've had a massive amount of excess money produced by the Fed since the coronavirus pandemic hit. Now it's 18, 19 months ago. And the Fed really, it's an incompetent operation. It's incompetence. This is the key word, incompetence. They have produced enormous amounts of excess money. And we have a Chairman Powell, who has testified in February that the money supply doesn't make any difference. And the money supply is irrelevant in terms of inflation. This is just nonsense. It's all about the money supply. So if you look at the bathtub that John Greenwood, chief economist at Invesco in London, and I developed, the bathtub has money going into the tub. And then there are two drains that take money out of the tub. One of those fuels real economic growth. That takes a little out. And then the second thing is the demand for money. Demand for money goes up as the economy grows. That takes a little out. And you're left with a huge amount of money in the bathtub that goes over the overflow. And with a lag of about 2 years, it starts going over that inflation overflow. And that's what we're seeing now starting. So this is going to last for a couple of years, David. That's the point. The excess money is already in the tub. It doesn't really matter what the Fed does right now. It turns out, back to your point, the money supply still is growing about twice as fast as it should be growing if the Fed wanted to eventually reach its inflation target of 2%. So they haven't been, the money supply growth, it has slowed down, but they really haven't tapered it down to an appropriate level. It's still growing twice as fast as it should be growing, but the Fed is so incompetent that they're not even looking at the money supply.
So Professor Steve Hanke is a self-acclaimed monetarist. Probably the most famous monetarist is Milton Friedman from the Chicago School of Economics, where they focus solely on the expansion of the money or currency supply, and hence the quantity theory of money. Now, Friedman and Anna Schwartz wrote a book, A Monetary History of the United States, 1867 to 1960, and argued that inflation is always and everywhere a monetary phenomenon. Now, Professor Steve Hanke quotes this all the time, and yes, they are partly right in the sense that the definition of inflation is the expansion of the money or currency supply. However, prices are then another thing, and there's two sides to it. But a lot of people confuse the Chicago School with the Austrian School around this issue. However, the great man of the Austrian School of Economics, Ludwig von Mises, had this to say about the quantity theory of money. Now, Ludwig von Mises agreed that there was a core of truth in the quantity theory, but criticized its focus on the supply of money without adequately explaining the demand for money. He said that the theory fails to explain the mechanism of variations in the value of money. And that's what I argue. There's two sides to the whole prices debate. You need to look at the increase in money or currency supply, but you need to look at the demand for that money. So the supply of goods and services and so forth. Now, another great Austrian economist, Friedrich Hayek, also had this to say about the quantity theory of money, and perhaps he is a little bit anyway. In his book, The Denationalization of Money, Friedrich Hayek described the quantity theory of money as no more than a useful rough approximation to a really adequate explanation. According to him, the theory becomes wholly useless where several concurrent, distinct kinds of money are simultaneously in use in the same territory. So there's probably a little bit more forthright there than Ludwig. But as you can see, the two big, guys of thought, thinkers of the Austrian School of Economics, doesn't agree with the quantity theory of money like the Chicago School, like the monetarists do. So, I really wanted to share that in this video, that there is a very distinct difference between the Austrian School and the Chicago School. And yes, both have similarities in terms of free markets, individualism, freedom, liberties, and all that sort of thing, and many other similarities, but there are many differences, including our philosophical outlook, where we, as Austrians, use Immanuel Kant's rationalism, and they use empiricism. So, we do have quite a lot of differences in terms of our economic theories and our philosophy behind our economic thought. So anyway, guys, if you like this video, hit that like button. Really do appreciate it. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you again on another episode of Finance Uncut.